Thank you, everyone, for joining. Yep. For those of you who I will dob you in a little bit for people who haven't joined our webinars before. So it's great to get some interaction. So I know there's a lot of people on this call that are senior in the recruitment parts of the business that they work for. So we'd love your insights as well. But so today it's how to recruit the right franchisees and empower them with financial knowledge so they succeed. So, you know, whenever the FCA or even IFA in the States do surveys around the biggest issues in franchising, franchise recruitment comes up as one, and access to finance is often in the top three as well. So we've got a lot of content to talk about because we're going to combine those two things. So for us, you know, they're both really important. For those of you who I haven't met, my name's Bruce McFarlane. I'm the CEO of BDC Partners. We might just jump this next slide. Thanks, Tanya. So today we're going to hear from Dave Lindsay. So Dave's the CEO of BDC Recruitment. He's also the founder of Hatch, which is a lead generation platform that some of you on the call know a bit about. And Dave was a franchisor and the founder of Salts of the Earth. And then welcome, Dave.
Thanks, Bruce.
Steve Whiteside. So Steve is the founder of Little Giants Finance. So Steve's been working in the finance industry for a number of years, and in the last probably 5 or 6 has been doing a lot of franchisee and franchisor finance, having done a friend data course. But prior to being running his own business in the finance space, Steve worked at Blue Rock in the finance team and also worked at NAB as a business banker. So he's got a lot of experience across the franchising and business banking worlds. Welcome, Steve.
G'day, everyone.
We'll just jump. So as many of you know, BDC, we're part of a group, BDC Partners. We've got 4 main operating businesses in BDC Partners. So we've BDC Property, we've got a law firm, we've got a recruitment business, and we've got BDC Performance that work across all parts of the franchise industry and retail industry. And then we're part of BDC Collective. And so Little Giants Finance, you see there, Steve's banner is nice and red, so we don't miss that on our slide deck now. He's just rebranded. It's looking great, Steve. We've got Fordham's, which do our accounting and M&A work. We've got Benjamin & Benjamin with insurance brokers. Associated Projects do fit out. So we basically partner with people to work across all different areas in the franchise and retail sector. But today, sorry, we're going to go to the next one just before. Today, it's all about franchise recruitment and franchise finance. So if you do have questions, I will be watching the Q&A on the way through, but also if your camera's on, sing out in case I miss you. We will be recording as you saw this. So if you have to jump away or whatever, it'll be recorded so you can watch it later. And you'll get some, and the decks that Steve and Dave are going to prepare, show at different stages. We can send them around for you as well. So you don't need to write everything down that you see on the way through. But Dave, we might go to you now. And so we'll stop sharing Tanya, I think, and we'll go to Dave and he can talk about all things franchise recruitment.
Thank you, Bruce. And thanks everybody for coming along. Hopefully the goal out of today is to share a little bit of knowledge and expertise of what we're seeing. We do in BDC franchise recruitment, we do recruitment across a multitude of different brands, and I'd like to just share what we're experiencing. Thanks to those out there who completed the survey. It just helps with regards to delivering the content and make sure that we have a meaningful conversation throughout this. Hold the questions, but please, if something is pressing, just let me know and I'll get it answered straight away. So I'm just going to share a couple of quick slides to run through the responses and I know it's a lot longer than questions that we had. But with regards to some of the key issues with franchise recruitment, like what are the pain points, you can see that number 1 there is lead quality, which we're going to address today. Number 2 is response rates, and number 3 is lead volume. I'd like to go straight to the response rates because you can see just here, we tried out email response or email surveys in our last webinar, and we received a 7% response rate from that. This webinar, we tried the SMS and we shot up to 35%. we have experienced this in our recruitment business as well, since the introduction of SMS, automated SMS, and not just making sure that it's just an SMS out, but if your application form or any of the main criteria that you need people to complete is SMS friendly, you'll actually find that your response rates get a lot higher as a result of that, because it's a lot more convenient. So I thought I'd just share that quick stat with you, just with regards to what we experienced just over our 2 webinars. Okay, what channels are currently being used? As you can see, Google Ads is leading the way, followed by Facebook, Instagram, and the business for sale directories, Seek Business and that there. What channels are giving the best results? Facebook is leading the way. Sorry, I need to put that on silent. Facebook's leading the way, with Google Ads and Seek Business following up. And listen, we're experiencing the exact same thing with our business as well. Facebook and Meta has done an incredible job with regards to the quality that's being delivered through. And I thought that I'd share this with regards to, does your landing page provide facts and figures about the franchise model? And we had a 69% response rate of no. And I'll get into that to show you some real insights as to what's happening on two of the businesses that we have with case studies. Does your landing page inquiry form in particular have particular requirements that qualify leads? Such as, do you have the investment amount to, or do you have the capital available to invest? And we have a 77% no response rate on that. So we're going to address those couple of items with regards to lead quality and how can we get better and more targeted at identifying these people, identifying the campaigns that are driving it, and also strive to get more of those people in. So how we strive for quality, a little bit of background about us. As Bruce said, I'm the CEO of Franchise Recruitment. Taylor, who works for me, does all the sales, and then Lisa does all of our lead generation, our digital marketing. We meet every morning. We are so aligned through our lead generation to our sales. We discuss all the leads that came in the day prior, and we're looking at the campaigns that we're working for the day prior. So what's the number one tip that I can give you that I can see that's working? And we've been test trialing this on a couple of different landing pages with a couple of different brands. Transparent content is actually king at the moment. We're living in a world where people are so busy that if you're not getting to the point of the information, or if you're not giving them what they want to see as quickly as possible, they just move on. So I would dare say we've been trialing and testing a couple of different campaigns that have been putting out some average sales figures, or putting out some profit figures, or USPs, and that has been delivering incredibly well for our campaign structure. The next problem we see is that when we sit down with a client, we actually say, what is the real investment? Because a lot of people price up, and this fits into the finance problem that Steve's going to talk about as well. But what's the real investment? When you're looking at what the overall investment for the business is, it's all up, everything, including bank guarantees, equipment, GST, what's the opening inventory they need to have. If you've got staff, let's say you've got 6 staff that you need to employ, and they need to go through a 3-week training course. Have you allowed working capital for that? So it's got to be your total establishment costs with no surprises. But general rule of thumb, and Steve will talk to this a little bit later, but let's say your total establishment cost is 300K. You're targeting leads that have a minimum of 150K, that have roughly 50% in either cash or equity available to them. Now, why is this also important? Because this will then feed into your leads, how you structure your lead campaigns, who you're targeting, the audience you're targeting. Are they in the top 10%, or are they the top 20% of income earners, et cetera, because you don't want your campaigns going and being delivered to people who genuinely can't afford your business. You need to do the work. You need to understand what the total investment is, and then understand what they need to have in order to put your campaigns on front of them. Now, I just want to jump into some tools, and I know one of the questions I asked, are people using behavioral activity tools on their landing page? And I thought that I'd share this first case study with you because it's a really important one and this is from Microsoft Clarity. Anybody who has never used Microsoft Clarity, I suggest that you look into it. It's an incredible tool. It's free. You can put it on your website and it's going to deliver information, a lot more information than what I'm going to present to you, but these are some of the key things that we look at. So when we take a look at this first case study, 85% of the traffic came in via mobile. One of the other things that we see as an issue is that the website hasn't been optimized for a mobile experience. And if you've got a really poor mobile experience, it actually drastically affects your lead quality that comes through as well. So make sure that your website performs exceptionally well from a mobile point of view, because as you can see, 85% of traffic is through mobile. But one of the reports that you have on Clarity, and this is over a 14-day period, is where they talk about user intent, and that's based on what are they doing on your website. Are they interacting with the landing page? Are they clicking on things? Are they watching videos? Are they finding out more information? But you can see with this brand that we have here, we've got a high intent rate of 21.5%, which is 121 sessions over the last 14 days. Now, you can see that all of the traffic, which is the total amount of people here, you can see the campaigns that are driving this traffic. So you can go, okay, well, these campaigns are delivering, these campaigns here are delivering, but these are not so much delivering. And it allows you to further dive down into the weeds and see what happens. Now, one of the beautiful things about Microsoft Clarity is that you can tag, okay, I just want to focus on high intent people and where they're coming from, what's their source. When I jump in, so this next slide here, as you can see, we've gone for the high intent, but all of the campaigns have actually changed. You can see what campaigns are now working well for those people, and you can get your focus for those campaigns. You may actually put a bit more spend into those campaigns to generate more high intent traffic to your website. The other part of Microsoft Clarity, which is really, really good, and I know you guys, you just see a couple of lines here with colors on it, but I'm going to talk through these because this is very important about scroll depth and attention on your landing page. So we've got on the left-hand side here, we've got scroll depth, and I've got all traffic versus high intent traffic. And you can see that the structuring of your landing page and understanding what people are doing is very important, because you can see right at this point here, with all traffic, there's a 64% drop-off rate versus on the high intent, there's only a 9% drop-off rate. But when you get to the very bottom of the page, 95% of people have dropped off versus 69% of your high intent traffic have dropped off. On the attention side, so now that we've got, okay, we've done the scroll depth and we can see how far people are going down and what they're looking at on the page. Now we're looking at what are they looking at on the page itself. So you can see that all traffic here, the main thing that they're looking at is down here. But if we were to actually cross a line with the scroll depth, there's probably only about 15% of people making it down to the main content that people of all traffic are actually interacting with. Versus if you take a look at your high intent person, you can see that it's a very, very different attention focus of what they are actually looking at. And when we cross-reference the high intent sections with the visitors, what are they reading? They are focused on these landing pages, we have network performance. So it might be average sales across the network, or average COGS, or what average profits, etc. So that's network performance. Then key USPs, like what makes you guys different? What's the difference with your brand? That's the next attention. FAQs are getting a huge amount of attention as well. And then the last but not least for the high intent is the inquiry form. So you can see that they've got the information, they're now ready to inquire. Now, we've done the same with another case study here. And this is another brand where we've now got 89% of the traffic is mobile. However, we've got high intent is a little bit less. So we've got a bit of work to do on this campaign that we need to refine and get better. But as you can see, we've got all of our campaign structure. There's a bit more widespread targeting that's happening. But when we go to the high intent, it all again changes and we take a look at, okay, this is what's working. So it enables us to make more how can I say, targeted decision making driven by data. Very similar concept with the scroll depth and attention. We've got a bit more of a drop-off rate with the high intent, but they are making a lot more are making it down to the bottom than the previous brand. But funny enough, the attention is exactly the same, the way that we've got it distributed on the website. They're looking at network performance, they're looking at the USPs of the business, they're looking at the FAQs, and they're looking at the inquiry form. All of the other stuff I would regard as fluff. And what I would suggest with this website or this page, we need to refine the campaigns to get a bit more of the high intent behavior happening. And then we need to probably start pushing up all of the relevant content that they are consuming higher to the top, where you're getting better scroll depths, which means that you're going to get a more intent-based inquiry, which will obviously affect your response rates. It will affect the conversations that you're having. There's quite a number of different knock-on effects. So that's with regards to the lead generation, the lead volume and the lead quality, which were the other two problems we identified. Obviously, lead volume comes from you identifying, okay, well, where is the best channel? Okay, here's the best channel. What's the best campaign that's delivering better quality? Okay, now I need to start upping my spend in that campaign. With regards to the lead quality, again, identifying high intent people, tracing it all the way back to their source and making sure you get more of them through. So there's a lot of test and measure that needs to happen in order for you to get to a point where you can make decisions based on the data. Jumping into the optimized cash flow forecast, which is another important part which feeds into Steve's side of this as well. One of the things with regards to high quality leads, and I asked the question, and I believe if I go back up with regards to, here we go, does your landing page inquiry form have particular requirements that qualify leads? And 77% said no. If you want higher quality leads coming through, particularly around finance, because one of the responses for Steve's section is that the lack of funds available. If we jump into this analysis here, or this total establishment cost of 300K for your opportunity, they need roughly 150 grand. You need to ask that on the form. Do you have access to 150,000 in either cash or equity? And we've found in our business, in our recruitment business, that this eliminates so many tire kickers. It means that you're now having conversations with qualified people who get through the process because they understand what the overall investment is. They understand what exactly it is that they need to have in either cash or equity in order to progress. We're not asking them to provide assets and liabilities. We're just asking them to acknowledge that they have it. And then it's up to us to actually fish that out as we go through the process. Then jumping into the optimized cash flow forecast. A good optimized cash flow forecast, and we've tried and tested many different variations, but one of the reasons why people come to franchising is that they want assistance, they want help, they want to go through a process. They're not entrepreneurial people. So for them to put together a forecast or something from scratch, they don't have the acumen to do it. And you have to make it as simple as possible and as dummy idiot proof as possible. So we've started including anonymized network sales. We're not saying these are actually fact checked from the year before, so the brand can actually prove that these were the sales per unit, so people can understand exactly what the earning potential is. Expense line items. So what's the low? So for example, for salaries, what's the low to high? And they can basically see, okay, well, we are 20 to 25% of revenue is our labor. I'm going to put in 23%, and it automatically calculates. A franchisee salary that's itemized outside of the total salaries, and this is important for lending because lenders want to see, well, what is the potential salary for that franchisee? A breakdown of the total establishment costs. So that, going back to that initial page that I had at the start, what exactly, like calculating everything out. A loan repayments calculator so that it's feeding into the P&L and they understand, okay, this is what profit looks like after I'm paying down. And then the forecasted P&L that includes that loan repayments. Now, this, you've got to build it that it's idiot proof, so that they literally have guardrails of low and high figures, and they basically are just punching in figures. The reason that you want to have it that way is that it also helps when it comes to lending, because they're not sensitizing the forecast as much, because the franchisor has provided low and high figures, so that the lenders aren't guessing, okay, well, what if this, what if that, and they're sensitizing it up and down. So a well-optimized cash flow has two knock-on effects. It educates the prospect about your business and gives them a degree of financial literacy of what to expect. And it also helps and assists with a good, with lending for brokers to get the deal across the line.
Dave, that might be a good segue, mate. So we might just jump to Steve to do some lending stuff, because I think I've got questions that have come through, but maybe we jump back to those at the end. Is that okay?
Yeah, that's okay. Yeah.
Yep.
Happy days. I'll stop sharing and pass over.
Yeah, so because I think a lot of the questions, I think it's probably not a bad time to jump back and have a look. Steve, if you want to share your screen now, mate.
Hi, everyone. So, I'm Steve Whiteside, Little Giant Finance. Was NAB business for about 10 years, and I've been broking for about 10 years. And as Bruce said, I was at Blue Rock for about 10 years, but I've just started my own company in October last year. There's a bit of information in my presentation. I'm not going to probably be able to get through all of this, but we'll do the best we can to cover off the main points. So basically what I wanted to cover quickly was whether business banks at the moment are lending to greenfield sites, which is always something that franchisors want to know. How do banks lend to businesses and franchisees, and the 4 C's of lending, which I'm sure a lot of you might know already, but we'll just cover that quickly. What does a bad franchisee lead look like? What's a good franchisee lead look like? And how can franchisors do more to help their franchisees get finance more easily? Just very quickly, this is pretty much how I see the market in terms of least expensive to most expensive.
Do you want to, Steve, your slides aren't sharing, I don't think, mate. Do you want to, number 2 didn't come up, so.
Sorry.
Look through to 3, cool, yep.
Yeah, so basically this is the finance market as far as I see it in terms of least expensive to most expensive. So, obviously you can go to mum and dad or family or friends and hopefully get a cheap loan. Then you can go to home loan banks and do cash outs to help finance business potentially through existing equity. You can do low doc loans now with accountant declarations and no financials. Then you can go to the business banks, which is primarily ANZ, CBA, NAB, Westpac, Judo Bank, Bank of Queensland and Suncorp for a proper business loan, which will require all the bells and whistles and the cash flow forecast that Dave mentioned. You can do commercial loan low docs as well. You can do asset finance lending and private lending if you really need to. And then you've got fintechs like Banjo, Prosper, Moolah, BizCap at the far end, which is like 48% interest a year. So that's pretty much the spectrum. In terms of business banks at the moment, in terms of how they lend to greenfield sites, so brand new sites, I went to all the franchise heads of all the banks, NAB, ANZ, Westpac, CBA and Judo as well, and asked them, are they actually lending to greenfield sites? And they vary substantially. So you've probably got I wasn't going to name names, but you've probably got ANZ and ANZ at the most aggressive end, and they will lend to greenfield sites at 50% on non-preferred or non-accredited brands, assuming, as Dave said, that the franchisee has 50% equity in cash, ideally, or they can work around and work with equity in property, but they ideally need to have the capital or the cash of 50% of the purchase price. And then they've got preferred brands on their list, which they have about 72 preferred brands, and they can land up to 60 to 65% on their preferred brands off the business itself. At the other end of the spectrum, you've got like Westpac, who are very conservative, and they only have 4 accredited brands, which is McDonald's, Domino's, Australia Post, and can't remember the fourth one. But they pretty much only lend to those in a franchise capacity, and outside that, it's very hard to get greenfield funding from Westpac. So in between, you've got NAB and CBA and Judo Bank who will do it on a case-by-case basis. But NAB, for instance, will only lend to a greenfield site if you can show you can service the new loan off existing income. That's if it's not an accredited brand. If it's an accredited brand, NAB will actually lend 50 to 65% on their preferred or accredited brands. And they can actually go up to 75 to 80% on McDonald's. So the lenders are lending to greenfields. It's just you've got a big variation between the ANZ and Westpac, and then in between you've got CBA, Judo, and NAB, and that's sort of how I see it. In terms of the way
just on that, Steve, so if the franchisee's got a relationship with CBA or Westpac, that's probably not a bad starting point if they've borrowed with them before, even though they're not aggressive in lending.
If the franchisor banks with the bank and there's a relationship there, then I would say you need to speak to the head of the franchise division, which I can make an introduction to any of the brands here, and just build that relationship with the franchise area. Depending on how many units you actually have, if you've only got 4 or 5 franchises, they probably won't put too much emphasis on it. If you've got 20 to 30, they'll definitely keep information on file and help hopefully bypass the traditional lending where they wouldn't do greenfields. A lot of them will be happy to do brownfields, obviously existing franchises being sold that have traded for a few years, or a multi-unit operator where they've already got one franchise and they're buying another one. That might be an exception, but yeah, it's about first building that relationship with the franchise area of the bank.
Cool, thanks.
Now, having worked as a banker for almost 10 years at NAB Business, we were drilled the 4 C's of lending, which, if anyone doesn't know, that's probably the most important thing to think about when you look at a franchisee application is, do they cover all these 4 C's? And the bank is looking at all these things every time an application comes through. So the first C is character. So this is a busy slide, but basically they're looking at, on the franchisee side itself, they're looking at the management experience. Have they gone through a profiling process with the franchisor for the fit in terms of their background? Do they have any business acumen, or are they organised? Is their credit file clean? Do they have a set of professionals helping them, accountants, bookkeepers, solicitors? No ATO debt. Does the business plan look professional? And does the actual purchase make sense in terms of their family household and who's giving up work to start the business, etc. And on the franchisor side, they'll obviously look at the site, how many sites there are. Do we have access to information around how many have traded for more than a year, and how many owners own more than one, which is a good sign that it's a viable business. The quality of the training that's provided, all that stuff, which is obviously no-brainer for most people, but it's something we have to cover off on. So then the second C is cash flow. So is the income to pay off the business loan only coming from the new business itself, or is there other income available in the group? Rental income, the partner's got income, you're teaming up with another group and you've got 4 incomes or something like that. So the typically the more people in an application, the stronger it's going to be, because you've got more people who can contribute their income streams. Collateral is C number 3, so it's a security involved. Some banks don't like to take security potentially. They just want the cash in 50% and they'll lend 50% as a business loan. But you can get a longer loan term. If you put a house or a commercial property up, you can go to 25 to 30 years instead of 5 to 7 years to match the term of the lease and the franchise agreement. And the 4C is capital. So that's how much cash is going into the transaction or the hurt money, because banks don't like lending more than 50%, ideally, if they can avoid it. And they're definitely not going to fund 100% of a transaction unless there's a real reason to do so. So those are the 4 C's. So it's character, collateral, cash flow, capital. Now, I was going to go through what a good lead and a bad lead looks like, but
You got time. Yeah, do that.
yeah, so very simply, I get a lot of these, but so this is a bad lead. So this is Gary, single male working.
Gaza. What about Gaza?
Gaza. He's working as an Uber driver for 6 months.
Why is it always Gary? It's always Gary.
He previously worked in IT, but he was made redundant. Wants to buy a $500,000 quick service food restaurant, and this brand only has 2 existing locations, so it's a very new brand. There's also a 3-month bank guarantee for this purchase of the franchise of 45 grand on top of the 500 grand. And he's got about 145 grand cash. He's got a car loan of 30 grand with 4 years left on it. He's got no other assets, and he's worked in hospitality for 8 years previously, and he thinks he has the skills. So obviously that's probably not going to work with any bank, because, by the time you take his 145 grand cash out, that's not even 50% of the 500, plus he's got to come up with 45 grand to back the bank guarantee. So it's just not enough cash, and there's not enough experience, and he's got no other income to rely on outside his Uber driving at the moment. So you would just pretty much move on from that, obviously.
Or you say to Gary, mate, or to the franchise, or maybe Gary needs a business partner.
Yeah, he needs a business partner. He needs, he needs to pretty much team up with someone else, even if he wants to get a personal loan on the side to try to get his way into that. Like you can get personal loans up to $100,000. If you use a car as well as security, can do that, and you get a 7-year loan. But even then, I think you're probably scratching it too hard. So, you're better off as a franchisor working on better quality leads if you can get them. Obviously, this is a good lead, Melissa and Anthony. Or you probably might not get leads this good, obviously, but you could have a couple with 2 kids, and Melissa works part-time as a doctor, earning 120 grand while looking after the kids. And Anthony's worked as a baker for 20 years, managing bakeries and staff. And for the past 5 years, he's earned about 80 grand a year as a baker, and he wants to start a bakery franchise. He's got good support from professionals. And he's got $1 million house, and he's got a 600 grand home loan against it, but he's also got 250K in redraw against that home loan. So one thing I always say is on recruitment forms and on franchisors' application forms for franchisees, make sure you know how much debt they have on the home loan and how much they have in offset and redraw, and know exactly what the debt level is, because a lot of people come to me and they say they've got cash of 200 grand, but they've also got a home loan of 600 grand with 200 grand in the offset, but it's really not. And they're telling me they've got 400 grand home loan and 200 grand cash, but they've actually got 600 grand home loan and 200 grand cash. So in this case, doing the numbers, this loan would work at affordability rates plus a 2.5% buffer. They only want $200,000 because they've got the cash and the redraw to fund the rest. So that's a good lead. In terms of what franchisors can do to help franchisees get finance more easily, as David touched on, it's about the recruitment form and improving the application form and the information you take around their financial position and other income in their family household. You also need to build those relationships with the heads of the business banks in the franchise areas, which change a bit, and they've changed recently. So I'm always trying to keep in touch with those guys as to how they're lending. And and I guess build a relationship with a broker who knows the franchise teams and also how to do a business transaction, how to sell your franchise brand and not just the franchisee. And yeah, just basically move on from bad leads if you can, and not spend time trying to get finance for someone who's 30 to 40% likely to get it. And yeah, have all those information, all that information ready about all the different sites and how long they've been running, and what their average sales are, their COGS, potentially having uniform sort of accounting systems. So that's probably all I need to cover off on.
Well, just on that, Steve, just so working with the franchisee to provide them with information about the network, is that what that last point was? Sorry.
Yeah, working with the franchise with
the lead. Yeah.
How to better how to better help them get through that process. So it's about providing them with all the information up front. The amount of times I ask a franchise lead for, the copy of the draft franchise agreement, or what's the bank guarantee, what's the total cost here, and they just don't seem to know, and they need to go back to the franchisor, but it's almost like they're not getting it quickly enough. And I've had a few times where the franchisor can't even provide that information readily in terms of the number of stores and how long they've been around and what their sales were in year 1, 2, and 3. And that sort of detail is really important if it's good quality information. It just seems to be hard to get that sometimes.
Yeah, so it seems like the sort of, Dave talked about transparency at the start about the information and a more of a collaborative approach rather than just leaving the franchisee to go to off on their own devices and go, see you later, go and get your finance, come back and talk to me, particularly if they are going to be borderline. You see a lot of good things about them from the franchisor point of view, but they're just not going to get across the line. That's just a waste of everyone's time if you leave them to, waste of their time, waste of Steve as broker, waste of the franchisor's time, if they're not going to get across the line. So if before you send them away, they're going to need a hand.
Yeah.
Bruce, sorry, it's Gary here. Franchisors or recruitment people, they shouldn't be sending people to Stephen unless they think they're going to be approved in the first place. So they should go through their process to see if they actually qualify, and that's when you send someone to a finance person, not beforehand.
Yeah, it's interesting, Gary. I think
even one layer back from that, and it goes to the point of actually asking the question on your form before they even inquire.
Yeah.
This is how much it is, circa this amount. Do you have access to it? Yes or no? If you do, let's talk. If you don't, let's look at other options, but we're not going to waste too much time.
That's right.
And Dave, with that, when you talk about quality leads, like I guess obviously that can be from a financial point of view as well as, other ways. So I guess there's two parts to this question. So one is, how do you screen quality leads, which we all want to know, but is it from a financial point of view? And then what about from a character point of view? Is, the profiling part of it as well? Yeah.
There's a couple of different things. Like it goes back to, I talk about the form being designed around the requirements of your business. So for example, there's a couple of builders on the call here where a builder's license may be required. Very simple as, do you have a builder's license? Yes or no? And if it's a no, well then we better look next time, or we can put you in touch or a partnership with somebody with a license. The other, it's just important because the success of franchise recruitment is ultimately being able to spend as much time as possible developing a relationship with that prospect so that they feel comfortable with the brand from start to finish. And if you're forever just digging through a wallow of crap leads, it means that you're jumping out of conversations that you shouldn't be jumping out of. You should be there being transparent, answering questions, and not rushing off to the next phone call because you've got another 50 to make today. You've got to have as many screening things in place. And that's why I always say the more information, like I take my hat off to Baker's Delight, what they've done on their landing page with regards to the transparency of the information. What that does is it creates hype about, this is a really exciting business. And then you get them to the form where it then vets them on the form before, and it goes, it's really exciting, but I don't qualify. better luck next time, because then it means that your recruitment people are spending time on that. Now, marketing generally go loggerheads against this, because marketing are KPI'd to generate lead volume, which is one of the responses that we had. Whereas recruitment's not about lead volume, it's about lead quality, identifying what's driving the quality and getting more of it. So it's about taking your time, getting it right, getting all of your filtrations and funnels right, to then having a better conversation and outcome.
So with that, so the lead quality, so there's financial questions, but also from a profiling point of view, I know that some brands there's different profiling tools out there. We use Oracle profiling at the start. So making sure that the candidate has the characteristics and qualities that would suit the franchisor.
Well, it just goes back to like, obviously we do a lot of work with Steve, and Steve gets a full application pack that we're collating and handing over to the franchisor, as well as then that gets passed over to the lender. But part of the Oracle piece is that it shows how successful or the alignment of this person, the likelihood of this person being successful in the brand to the top performing franchisees. And it's that extra step that the credit manager's looking at, going back to the character of the franchisor. How are they recruiting these people? Are they just getting them to go off and do their own thing? Or are they actually got a deselection process? I always say recruitment's about a deselection process. It shouldn't be seen as sales. It should be seen as developing a relationship, seeing if they want to follow the process, follow the systems, answering, communicating, everything like that. But the profile is that next step that then goes, okay, you are a match to our business. Because at the end of the day, franchising is a people business. If your people don't get along with each other, you develop toxicity within the group, and then that's detrimental that has a knock-on impact to a whole lot of other things around operations.
Cool. So you talked a bit about where the leads are coming from before. So I know Facebook seems to be a pretty good place for where leads are coming from at the moment. And so some systems go, getting great leads through Facebook, whereas others, it's like, my campaigns aren't converting. What am I doing wrong on my Facebook campaign? Is that something you're seeing a bit of? So
and listen, we've done a bit of work. Recently, or I'm not going to say recently, a couple of months ago, where a group were looking to, they great tenure, really, really good retail, old business, and a lot of franchisees, long tenure. They're looking for succession planning. Who is the next franchisees that we want? We want young, vibrant retailers to come through. All of their marketing collateral, whereof, and I'm not ageism here or anything like this, but it was all retiring people. So you need your content. Your content needs to be refreshed to reflect exactly who you're looking for, because people, when they're going through their feeds or they're going through the targets, you've done the hard work identifying the interests, the where they're looking at, the brands they follow, etc. Then you place the wrong imagery on front of them. Well, then you're not going to grab their attention. You've got to understand what grabs their attention. Can they see themselves in that brand that instantly goes, hey press, there we go. Like, for example, we've tried and tested a couple of campaigns where we are actually showing sales figures, average sales figures, and it's driving people in. And the first thing that they go straight down to, you can see it in clarity, they go straight down to the figures, they start educating themselves, they get to the form, and then the form deselects them or selects them. But you should always be refreshing your content to target the type of person that's going to be attracted to that.
So that persona, so working out who your ideal franchisee is, and it's not going to be one, there's not be exactly the same. I know maybe Patrick with his Hire a Hubby franchisee, maybe they are retired people that are retired tradies or something. That could be a good lead, but I'm assuming people buying a bookstore are different from people buying an express business compared to Ben's, fitness franchise. There's a whole
say it.
Thing,
Say it in your content. So, for example, we've got a restaurant business that the franchisee is required to actively work in it for the first 12 months. We say it. It's part of the selection criteria. You have to be actively involved, hands-on in this business for 12 months, and you agree to it. that's showing your expectations. Because if somebody's going, oh, I just want to invest because it looks like a great investment, okay, this doesn't suit me because I can't commit to being actively involved in that business for 12 months.
The investor. And what about the other one around differentiating? You know, it's food and fitness are probably two of the bigger ones. Is how do you what is my unique offering that's different from someone else? How do you?
Well, I done an interview with Ben from Listen to Your Body, and one of the things that blew me away was that he's targeting a very different market. And I don't know, Ben, if you want to jump in, the USP that we spoke about being the people who, you know, the 83% of people who are at home unmotivated. You know, like that is a key USP for the business, because then it means that you're not following the trend of these fitness buffs, and there's, you know, 100 different boutique gym franchises going out there chasing those customers. Like, really understand what the unique selling point of your business model is, and also your customers as well, and get that across to your prospects, because they'll relate to it. They'll honestly relate to it.
Cool. Ben, do you want to add to that, or has he covered? Summed you up? You're on mute. Sorry, mate.
Yeah, I think they pretty much covered it. But yeah, that's obviously been our target market for a long time, and we try and communicate the best we can. And a lot of leads come in, they're already, not all of them, but they're already semi-educated who we work with. We even just had a lead just before this call from Brisbane, actually, and talking about the interest with us because of who we go for. But it's just, yeah, it's about ways of communicating that clearly is the ongoing challenge, I guess, to do that.
Yeah, cool. And Kelly, what about Marcel, when you're looking at someone for an inexpress franchisee, what's your unique selling proposition, or have you got that in the persona of the franchisee? Is that all sorted out?
I think you're just looking for that person who's got the work ethic to take your brand to the next level. So those first conversations and a robust recruitment process that ends in a panel interview where the management team meets them and make sure we're all aligned in our goals is more important than ever these days, to make sure we're bringing the right people into our brand so that we can all succeed.
Yeah. Yep. And then the transparency of finance, you know, a lot of your franchisees are pretty successful, so understanding that the financial aspect of being a franchisee, has that come in pretty quickly?
Yeah, it has. We've got, as part of our process, we're able to share a bit of data from last year to give them some informed information to make decisions based on. As far as funding goes, Stephen, like, we're lucky with the price point. It's only $85,000 plus GST. So far, I found the majority of people are coming in as cash buyers, which is a refreshing change to go through. But Stephen, my question for you though, back in the day, there's always been some robust discussions around whether a franchisor should be giving a cash flow forecast template and business plan template to make it easy, or should they show that they're entrepreneurial and have can prove that they are actually capable of running a business? Do you recommend we spoon feed, or do you think it's best to see what someone's capable of?
Yeah, I think that's when you know how strong they are. But I normally give my clients just the ATO or NAB business plan document and cash flow, and I've got two versions of it and as a guide. But I understand that you can't just spoon feed them too much legally. You can't just spell it out for them too much, because you can't just say this is what's going to happen. But I think having a guide with the ranges of what to expect, as David was saying, around salaries, and being clear around the management wage and all that is so important, because often I get a cash flow. I'm like, is that wage figure, does that include your wage, or is that are you just going to take the profit? And that's always unclear. But I don't think spoon feeding too much, but saying this is a guide and just saying having something there is really important. And then maybe having a separate version that's a ATO version or something separate as well might be handy for them. And a business plan guide that's from the ATO itself. But you're right. You can't kind of spell it out too much, and then they just fill in the gaps. I mean, that's what David's saying is sort of make it down, which I understand too, because these guys probably don't want to spend a whole weekend creating a business plan. So if they have some sort of momentum, it's going to help a lot. Yeah.
So it's striking that right balance, isn't it? Because they're buying a franchise, because if they were starting their own business, they'd be doing it themselves. So having support from a franchisor in planning, both from a financial and a business planning point of view, seems to be the right mix. But I guess it's a bit about transparency, isn't it? About the financial information, what you can and can't do. There's from a legal point of view, yeah, it's a fine line. I think, you know, Kelly, you've been in the bigger systems for a while, but it's also the smaller systems that don't have the data. I don't know, Dave, we work with large and small systems, but the challenge for the emerging franchisor with less than 25 units that doesn't, and particularly going into a new market where they don't have the data around that, is that something that you'd sort of have to help them with?
Yeah, no, definitely. Believe it or not, it's actually easier to implement that behavior with the smaller brands than the larger brands, because it's you're not trying to get as many franchisees on board, but it does take a bit of coaxing to get that data out of it. Number one, I question with regards to why aren't we collecting that data to understand benchmarking and performance, so that we can see whether you're up and down, or whether you're spending too much on COGS or you're spending too much on salary based, because at the end of the day, the business model is the business model. You've got benchmarks that you need to perform by in order for the business model to be successful. We should be measuring them. But then getting that translated, collecting that information and then translating it into a forecasting tool, I find it's a lot easier with the smaller brands than the larger brands.
Yeah, and that's a similar thing, Steve, with finance. Obviously, the larger brands, you know, there's track record, and so, you know, they're either accredited or they're preferred or whatever they call them now across the brands. But when they're a small emerging brand and they don't have the information, it's trickier. So what about when you on your scale, you had all the, you know, the big four. So let's move down from the big four for a minute. You know, do you still have to educate those other lenders, obviously judos across it, about franchising and about the process to get them?
The business finance market is very small. Judo was a breath of fresh air. You got the big four banks, and outside that, for instance, Liberty Bank, who are non-bank really, but they opened up an area called Liberty Capital. But then I've now approached them for a franchise deal, and they just flat out say we won't fund franchises, which is great. And then you've got Bank of Queensland and Suncorp, and they're really security lenders, and they won't really do greenfields at all. So you are stuck with the big four and judo, and that's it. And they understand franchising, so it's limited. And that's why a lot of people get cash out of their home loans and play the game and do a cash out, because it's the only way. And through COVID and everything, it was the only way to get money is to use your existing income and do a cash out. And that's how we kept going. Banks don't like doing cash outs for business because they think investing in business is higher risk than investing in property. And that's the way it's always been. They don't want to know about it. But yeah, you kind of, you know, as I say, you kind of cobble together different options, and asset finance, you have to really look at the whole market and think creatively about how to get this thing done. Can you full finance from some other way, and then after 12 months when you got trading figures, then restructure it and put more against the business and less against your house and all that. Yeah.
If I go back on my own journey, Bruce, when I was running Salts of the Earth, I actually created a presentation, an overview of the business with the network performance, the bottom performance, the mid performance, and the top performance, and a well-designed recruitment process, as well as how we support franchisees with a bit of crisis management. If something goes wrong, here's what we do. I actually went and I sat with all of the bankers and I developed a relationship, and we basically caught up every 6 months just to give a quick update about where we're at, what we do, and what's been the update. And I still have those relationships in place to date. What that does is it goes to what Steve was saying, is the character of the franchisor. It shows that you're forthcoming with the information. And yes, I was a young brand, but I didn't need to be on a lending panel. I had all the banks lending to us because I had the relationships in place, and they saw that I was actually I was working hard to build a network, and they were backing that character.
Cool. We might move away just from finance for a sec, but some of the smaller investment levels, like, you know, we've got Blue Wheelers on the call and others, Kelly, you said yours, where there's not a lot of finance, moving to responses and follow-ups and things like that. So Dave, you know, people filling in forms and then they disappear, and like what happens then, or, you know, like that, you want them to deselect, so you want them to show they're keen, but at the same time, you know, it's a competitive market and there's lots of brands around. I know we have examples where franchisors aren't following up the leads for a long period of time. Even Computer Explorer is one of our brands. What about, you know, how are you seeing that in terms of automation, AI, CRMs, how that's all tied together?
Yeah, it's amazing. So like with regards to leads, like how we use HubSpot, and like bringing on a franchise brand, there's a massive amount of automation and workflows that are built for all different scenarios. Like one of the scenarios is if they respond no to the finance, they go into a very particular nurture sequence for the no, which helps educate them that potentially we may be able to introduce you to a partner or somebody like that. But it's just warming, cooling that lead down and it's not just a flat out no, boom, all the way through the introduction of SMS. SMS has been a game changer for our recruitment business, because people are busy. SMS that's integrated with HubSpot, so like they can book into our calendar. So as soon as they inquire, they get an SMS with the information pack, followed by an SMS with, hey, book into our calendar here, so that we're not disturbing your day. They get one phone call from us. If they don't respond, we try and respond in a couple of hours after the inquiry, apart from weekends. But if they don't respond, they get pushed into a contacted sequence, which pushes them the whole way through. We only try it once, but believe it or not, the system will hit them 9 times. Every time is to, you know, let's reach out, touch. If they're not going to respond after that, they go into a nurture sequence over a 6-month period. You would be amazed how many people have been chasing the information for now, and they're not ready to buy just yet, but then they go into a nurture sequence and they get educated further and more updates about the business, and all of a sudden they enter back in. We finished with a client about 9 months ago, and shortly after, about 2 or 3 months after we ended the agreement, 3 leads entered back in from our nurture sequence, and we're in the process of selling them. So like it is imperative that you actually have the get-go, because you have to understand, put yourselves in their shoes. They want to research, they want to learn. They're not just buying straight away. They want to learn as much as possible. They're probably getting ready for a career adjustment or a life adjustment, depending on the level of investment. They want to get all their ducks in a row, and now they're ready to make that jump. But you've got to have the tools that keeps you front of mind as opposed to back of mind for that.
Yeah, and in terms of response, because I know people I've got 4 kids under 20, under 30, and they don't answer the phone ever. They even know they carry it around the whole time. So is it you know, in terms of response rates, it sounds like you're expecting that people aren't necessarily going to respond, and then conversion rates and stuff.
Well, it's amazing the difference between, so we give the opportunity for people to book in straight away, book into our calendar. The difference between the lead quality of talking to somebody who's actually booked in versus somebody who you've picked up the phone just because they haven't booked in, and you end up striking up a conversation, it's chalk and cheese. Because those people are ready to learn, whereas these people are starting to research. And it's understanding those 2 different sequences that you need to go by. But I can honestly say, like, even just for this webinar, the response rate increased drastically from 7% to 35% from email. SMS is a game changer.
Yeah, cool. It's right on 12. I just want to bring up one more slide, I think, just to show, but thank you very much for everyone for joining. We will, like I said, we can send the decks around, so there's information there, some contact details. We'll send the recording around. We are running another webinar in August, on the 19th of August, it's going to be more around M&A, so return on investment at both franchisee and franchisor levels. So we'll refine that topic, but how do you help franchisees to sell their businesses and get a return on investment? But also as a franchisor, if you want to raise some money or raise or sell your business, what sort of things should you be doing at a franchisor level? And then lastly, we've got we have run a couple of other webinars this year. So the last one we did was around that breaking through that 25 location barrier. So if you've got any information, for those of you that joined that, we're happy to jump in and have a chat to you about it. We did a property one before that, but also we've got some information. So if you missed the previous webinars, it's also available on our website. But thank you very much. Thanks again, Steve. Thank you, Dave, for your insightful presentations. We did get through a lot of content today. Well done, gents.
Thank you.
Thanks, everyone, for joining.